Big thanks, Jochen. Big thanks to the Michaels family. Actually, some of you were here 2 years ago when I said Patrick Michaels and I did a little road trip from one of the conferences in Colorado, from Beaver Creek down to Colorado Springs. We did a 2-day road trip through some national parks. And this year we did it again, and we had a near-death experience. Because Patrick and I said, okay, let's do a road trip, just the two of us. Let's drive through Colorado. It's called the Alpine Pass. And we said it's going to take like 3 to 4 hours. And those of you who know Patrick, they know that he's always in a... He was driving, but he's always very, very optimistic. But after 10 hours, I said, okay, Patrick, how do you feel like? And he said, it's critical. So I realized, okay, we'll be very, very glad when we're back in the hotel safely. And he did a tremendous job driving, but I have to tell you, if Patrick Michael should invite you for a little road trip in Colorado, check out Google Maps in advance, yeah. So, but thank you very much again for taking the time. I will try to make that in like 30, 35 minutes. I will do my best. And the leitmotif of this year's In Gold We Trust report is the new Gold Playbook. Now, let's start it with an example for changing the rules from the world of nature. What you can see on this slide is the so-called peppered moth. In German, Birkenspanner. So how many moths can you see on the screen? 4. Excellent. Great job. But it's not really easy to see them. This one, for example, is pretty well covered. Now, the interesting thing about the peppered moth is that it actually adapted during the Industrial Revolution. Originally, they were mostly white with a few black spots, so like this one here. But during the Industrial Revolution in the UK, pollution covered the tree bark, die Rinde in German, in black soot. So these white moths became highly visible to all predators. But then nature made a color adaptation. And these moths turned black, which helped them to adapt to the new environment and to survive. Let's look at an example from sports. Wimbledon. Years ago, tennis was played with wooden rackets, obviously. Now with graphite and carbon fiber, the game has completely transformed. And you could tell that by the wear patterns on the grass courts of Wimbledon. This picture is from the 1970s. You can see from the wear on the grass across the entire court. This one is from the 1980s. I think that's Björn Borg, actually. With the move away from wooden rackets, the serve and volley strategy took hold. So you can see the wear patterns here and here. And the third picture is from 2018. Unfortunately, that's not Roger Federer. I'm sorry about that. But actually, with graphite rackets being the new norm, hard-hitting driving from the baseline is now the predominant strategy. So changes in technology have changed the game of tennis. But what if we fail to adapt? There are many examples from the world of business. Olivetti. My father-in-law worked for Olivetti. It was one of the top companies in the 1970s. Everybody wanted to work there, like, I don't know, Google, Apple nowadays. Kodak, Nokia. These companies completely failed to adapt to technological shifts. Now, in today's landscape, we're also seeing a big shift happening. So not adapting to a new playbook could become fatal for investors. You don't want to share the fate of the white peppered moth, show up at a tennis game in Wimbledon with a wooden racket, or watch your investments crumble because of a failure to adapt to the new Gold Playbook. Now, what is this new Gold Playbook that we wrote 450 pages this year again? Well, actually, sometimes my predictions are accurate and then I'm showing them in my presentations, because last year, at that time of the year at the Precious Metal Summit, I said that if gold should break out of the consolidation pattern, then we would see the technical target at 2,700 US dollars. Let's not forget, ladies and gentlemen, 1 year ago, the price of gold was trading where? 1950, exactly. So that was a big move. Now, if we have a look at the chart, obviously, there was this big consolidation pattern. 4 years we've been flirting with the 2,000 US dollar barrier. Now we broke through that barrier, and now gold and gold investors are actually entering terra incognita. But what is interesting in this environment, what is really remarkable, is that according to the old gold playbook, actually that shouldn't have happened. Because in the old paradigm, it was completely unthinkable that the gold price would actually rise in an environment where real interest rates are rising. In the old playbook, rising real rates were huge headwinds for the price of gold. But something happened in 2022. Another thing that happened, we're seeing ETF demand over the last couple of years developing very similarly like the price of gold. So as soon as we're seeing rising gold prices, we're seeing inflows into gold ETFs. Falling prices, outflows from the ETFs. But here's a big gap. So actually only in the last 5 months, we've seen very modest inflows into the gold ETFs. But since then, we've seen 1,000 tons of outflows from gold ETFs. So the message is clear, ladies and gentlemen. Western financial investors have missed the gold train. They haven't joined the gold party yet. Now, what is a major chapter of this new gold playbook? What we're showing on this chart is global central bank demand as a percentage of annual gold production. And you can see that in the 1990s up to the great financial crisis, central banks were net seller. So they were actually providing gold to the market. And that was up to 30%. We all know that Great Britain, the infamous brown bottom, and also Switzerland were selling gold, but also Austria, lots of countries were selling huge amounts of gold. So this was pretty significant. Then with the great financial crisis, it actually changed. We saw like between 15 to 20% of annual production were actually being purchased by central banks. And now, since the year 2022, central banks are soaking up almost 30% or 25% of global gold production. Now, obviously, the gold market is a big market, so there's not only the annual gold production, but with this comparison, I want to show you that central banks have become a major driver of this bull market in gold. Now, the second part of this bull market is coming from something completely different. Imagine you're in the year 1980. It's actually the year when I was born. ABBA came out with Super Trooper. Star Wars, The Empire Strikes Back is in theaters. And Jimmy Carter is actually preparing to hand over to Ronald Reagan. Back then, you could also light up a cigarette on the airplane. And actually, people were smoking like chimneys on the plane. People tend to forget that. I'm still not sure if the baby is actually holding a cigarette or if it's a lollipop. Now, why am I coming up with that picture? Because 1980, that's actually the time when the last big bond bear market ended. Since then, we've moved into a market landscape where bonds have almost reflexively been seen as safe havens, like Pavlovian dogs. we were all basically conditioned to rush into bonds at any sign of economic weakness, totally factoring out inflation risks. So here's the challenge. Have we become too conditioned to believe that inflation is a thing of the past? Have we become too conditioned to believe that bonds, especially government bonds, are safe havens? Have we or investors failed to prepare for the next inflationary wave? Let's see. What this chart shows, it might sound a little bit technical, ladies and gentlemen. It's the 10-year annualized inflation-adjusted performance of the 10-year US Treasury note. And it shows you that actually the last 3 years have been brutal for bond investors. But still, if we compare that to the 3 previous big bear markets in bonds, they lasted for more than a decade. So the second chapter of the new Gold Playbook is the fact that government bonds are no longer the anti-fragile portfolio foundation that they have been for the last 40 years. People tend to forget everybody's only looking at equity risks. But in 2020, actually, we've seen negative yields in some cases. But then actually, the 10-year US Treasuries fell by 29%, and the 30-year bonds in the US fell by 49% from their peaks. So from my point of view, this bear market on the bond side is definitely not over. Let's have a look at this chart. It shows US debt held by foreign central banks as a percentage of total debt. And on the other scale, you're seeing central bank gold holdings. Now, I don't know if you remember my analogy from the world of professional wrestling. Who remembers that one? Sorry. Who's that? The Rock, right. Before he became a movie star, an action star, he was a professional wrestler. And he started as the bad guy, as the so-called heel. But then he was so popular as a wrestler that the audience said, this guy is really a good one. We like him. So he became the so-called face. And this is called a heel turn, when the bad guy becomes the good guy. And this is something that we're experiencing in the global financial system. We saw that actually in the 1980s. Gold was responsible for almost 75% of international FX reserves. Will it rise to that level again? I don't think so, but it could easily double to 40% in the next decade. And what you can also see on the right scale is US debt held by foreign central banks. And you can see that we're going down from 70% to almost 50% at the moment. So our take, and this is really a long-term forecast, is that gold is really coming back into the world monetary system as a neutral monetary reserve asset. So we're seeing a heel turn in the international monetary universe. Now, we all know that every year we hear speculation about the new BRICS currency. And while it's still on the horizon, what is crystal clear is the commitment to moving away from the dollar in bilateral trade. So BRICS central banks, but also citizens, private citizens in the BRICS nations, are stockpiling gold like never before. If you have a look at this year's declaration from the BRICS, it's quite an interesting read actually. But what was particularly interesting was the fact that for the first time, the BRICS nations, they emphasized reforming the current international financial architecture. And you can read it in that declaration not once, but actually 4 times. So they're really serious about that. What is not happening is that they're introducing a new common currency. Many people said already last year, the BRICS will introduce a gold-backed currency. Even President Putin said, the time has not come yet. But what they introduced is a payment system called BRICS Pay. And actually, at the BRICS Summit, you were able, as a participant, to buy coffee with a QR code. So actually, this BRICS Pay system is completely circumventing, it's avoiding the SWIFT infrastructure, which is a pretty big thing, especially if you want to avoid sanctions. So the BRICS, ladies and gentlemen, they're playing the long game. It's not a trade alliance. It's actually a shift to a new economic order with capital not being recycled into US treasuries anymore. And I think that gold perhaps doesn't play the central role, but it plays a very important role in that game. And the third thing of this new gold playbook is the fact that gold demand is shifting east. We're seeing that emerging market investors are now the new marginal buyers. I was attending a conference in Dubai last year. Of course, I went to the gold souk. Dubai is responsible for 25% of global gold trade at the moment. Last year, 65% of total jewelry demand, physical jewelry demand, were coming just from China, India, and the Mid East. Of the physical investment demand, coin demand, and bars, investment bars, more than 50% came from China, India, and the Mid East. So the Western media keeps telling us that gold is rising because of high deficits and inflation concerns and crises. But from my point of view, Western media completely forgets that gold is also rising not because of fear, but actually because of love and gold affinity in emerging markets. And that's the interesting thing. Louis Vicent Garve, one of the most brilliant strategists out there, he said gold is a low beta emerging market proxy. So he thinks that with rising prosperity, and you're seeing GDP per capita growing much more dynamically, but also population growth in emerging markets growing at a different pace compared to the Western world. With this continued growth in emerging markets, this will be a natural tailwind for gold, for gold demand. So this is the positive story that people often tend to forget. Emerging markets love gold. They love physical gold. And this has been confirmed by a terrific study from the World Gold Council recently. They had a look at intraday returns in this year for gold, and they said that actually the majority of all returns are now coming from Asian trading hours and not from Europe or US sessions anymore. So if you want to understand gold and the emerging market demand, just travel to Dubai, travel to China, travel to India, and really feel, smell, and understand what the gold affinity in those countries is. I think it's really worth doing that. Now, let's talk about the new gold playbook and what it means for portfolio construction. Adam Grant said, we laugh at people who still use Windows 95, yet we still cling to opinions that we formed in 1995. Now, what could bring the Western financial investor actually back into the gold trade? It could be, obviously, the realization that the debt situation is not sustainable. In August alone, the US posted a $380 billion budget deficit, up 50% from 1 year ago. What you can see on this chart is, first of all, the US debt development in absolute terms. So now we're trading at 35 trillion US debt, and this is the year-on-year change. Now, of course, we've got a new president-elect. Obviously, that's the very big topic. And he's a gentleman who also said, I am the king of debt. Now, I know that the last couple of days for gold have been pretty rough. I know that many people say that's mainly because of Donald Trump and his policies. But if you remember the first time that he was elected, we've seen exactly the same. Gold was selling down. And then actually in January, gold started trading up. Actually, during the first term of President Trump, the price of gold was up 54%. from 1,200 US dollars up to almost $2,000. Now, from my point of view, the Trump presidency is ultimately bullish for gold. As I've said, Trump loves debt. He built his real estate empire based on debt. He went bankrupt actually 6 times, I think, in 10 years, something like that. So the last time Donald Trump was president, US public debt rose 7 trillion or 35% during his term. If he spends like in his last term, we could expect to see US debt rise to 50 trillion in the next 4 years. So I don't really fear Donald Trump. I think it's not going to be a decisive factor for the price of gold. But I think that the market, after making such a big move in a very short time frame, the market was looking for an excuse to actually correct. But this is a healthy breather that we're experiencing now. Now, something that is much more important from my point of view, from a portfolio construction point of view, is actually the negative correlation between stocks and bonds. And this has been taken for granted by the vast majority of asset allocators. So actually, bonds will save your portfolio in times of stress in equities. But actually, if you have a look at the longer term chart, this is rather the exception than the rule. So actually, if this correlation reverses permanently, the basis for the so-called 60-40 portfolio, which is the majority of all investment strategies out there, the basis of the 60-40 portfolio could be removed. Now, this is why we came up with a new kind of standard portfolio in our last In Gold We Trust report. We said that this 60-40 mix of equities, 60% stocks, 40% equities, this is based on backtests, and this is based on this negative correlation. It's based on the fact that inflation over the last 4 decades was a very, very little concern for investors. We've actually seen disinflation for almost 4 decades. Now, we said for the times that we see over the next couple of years, we would suggest a new 60-40 portfolio. So our proposed portfolio would be 45% stocks. For some reason, people think that if you love gold, you have to hate equities. That's complete nonsense. I would say that the true competitor of gold should be bonds, should be actually government debt. So we say 45% equities, 15% bonds, perhaps a little bit more corporate debt, a little bit more emerging market debt. Then we suggest 15% physical gold. So this is safe haven gold. Should be stored outside of the banking system, perhaps outside of your country, as little counterparty risk as possible. Then we're seeing 10% performance gold. What's performance gold? This is a part of your portfolio that should be actively timed. That's gold and silver mining stocks. We suggest roughly 10% commodities and 5% Bitcoin. Now, I know that the Bitcoin crowd is partying today, while the gold camp is suffering. We always said that actually gold and Bitcoin, they aren't enemies, they're kind of cousins. We run 2 investment funds extremely successfully that actually combine gold and Bitcoin, because over the longer term, there's a very, very low correlation between gold and Bitcoin. So it makes sense to combine both. So this is our suggested rule of thumb portfolio. Now, the interesting thing is we crunched the numbers. So we did an academic study that we published a couple of weeks ago and analyzed the optimal gold allocation. So based on very or somewhat sophisticated studies that we did, we came to the conclusion that actually the optimal portfolio allocation to gold should be between 14 to 18%. Higher allocations don't really improve the Sharpe ratio of your portfolio. But if you, as many investment banks, for example, advise, if you hold 1 or 2% of your portfolio in gold, it doesn't move the needle at all. So our take based on that study would be roughly 14 to 18%. Now, who owns 14 to 18% gold? I would say very few people. There was a study from Bank of America last year, and they said that 71% of all US advisors, investment advisors, actually have less than 1% in gold. So that confirms this very, very low affinity for gold. And if you have a look at this study by my friend Charlie Morris, it shows gold ETFs as a percentage of total ETF volume. Now, obviously, ETFs are highly successful. It's a huge success, and therefore lots of new ETFs coming out. So we shouldn't compare it to, for example, 2011, when actually gold ETFs were 17.6% of the global ETF volume. But still, at the moment, we're at 2.9%. So from all ETFs worldwide, only 2.9% is allocated in gold ETFs. So this tells us one thing, ladies and gentlemen. Western investors are massively underweight in gold. Just a few years ago, actually in 2020, gold ETFs reached 6.1%, a level that we could easily see over the next couple of years. So the message is the gold party has been started not by Western financial investors, but rather by emerging markets, by central banks, by people that understand that inflation might actually start a new wave fairly soon. But Western financial investors, they see the party, it's going crazy, but they haven't joined the party yet, and they're hesitant to get in at higher prices. Now, when it comes to mining stocks, obviously, I started writing about gold 18 years ago. I started investing in mining stocks 20 years ago, roughly. So we all know that mining stocks are highly volatile. You can make huge amounts of money, but there's also significant drawdowns, down 83%, 67%, 83%. So you gotta be active in the mining space. There are a few top-notch management teams in the world where you could say it's really a buy and hold. But I would say for the majority of the sector, you really have to be active. If you don't have the time and the nerves, outsource it to a manager, to a fund manager that does nothing else than worrying about all the things that can go wrong in mining. But what we do, and this is our approach, we said, okay, we're managing it based on a top-down approach. So we came up with the signal, which is called the incrementum active aurum signal. And there's some indicators that we use. So there's a cyclical signal and a fundamental signal. Now, this is pretty complicated, and I have a presentation about that. But what is important, and you might ask yourself, what is the signal showing now? And actually, since December 2023, we've got a green signal. So now we're really playing offensive. Now is the time to allocate in the gold mining space, in the silver mining space. There will be a time again when the signal goes to neutral or even to red. But we're not there yet. And as far as I can anticipate the signal, it seems that we will have a positive signal for the next couple of months. Now, where will we be going over the next couple of months, over the next couple of quarters? Michael Kosaris said, in a bull market, the sideline is the worst place to be. And this is exactly where Western financial investors currently are. They are on the sidelines. Let's have a look at the performance table. You know that the price of gold in different currencies. And you can see that actually gold is up 31% year to date. 31%. That's a big move. In euro terms, 34%. In the Swiss franc, we're up, where is it? 36%. In Japanese yen terms, up 42%. So gold has been rising quite significantly. Or if we take a different perspective, we could also say the Japanese yen, the euro, the dollar have devalued against gold big time in 1 year. Now, what is interesting is we've actually seen 4 years in this bull market with double-digit returns. If we compare it to the last big bull market, 2002 to 2011, in 8 out of 10 years, we saw double-digit returns. Now, my take, ladies and gentlemen, is we're probably not at the very beginning of this trend. Gold is not a super contrarian thing. But there's the saying, never be the first to arrive at a party or the last to go home, and never, never be both. So from my point of view, we're somewhere in the middle of this bull market. Again, it's not super contrarian. Like, I remember it pretty well. I was at the Denver Gold Show in Colorado Springs, and the Wall Street Journal came out saying gold loses its status as safe haven. We're somewhere in this so-called public participation phase. Now, what makes me pretty confident is the fact, if you have a look at Bloomberg, and if you look at the CPF function, which shows the commodity price forecasts by, I think, 40 forecasters on Bloomberg, all the big guys from the big houses, they're forecasting 2350 in 2025 and $2,220 by 2026. Now, the question is this the analyst behavior that you usually see at the very end of a big trend? I don't think so. Usually you see analysts going crazy at the very end, and everybody is coming out with crazy price targets. Now have a look at this chart. It's from Jordan at the Daily Gold. It shows a comparison of the price of gold, how it performed after making new all-time highs. And I think that's a pretty interesting one. So in 1972 actually, well, this is the dark blue line, 78. We've seen this crazy move where the price of gold actually doubled within only a couple of weeks. Then we've got 2007, which was a very, very long bull market. And then we've got the average, which is longer and then also much more aggressive, more exponential at the end of the trend. If we compare it to the breakout from the new all-time highs quite recently, you can see that it's still fairly muted. It's below average in terms of price performance, but also in terms of length. Now, talking a little bit about interest rates. We did a study recently where we analyzed how does the price of gold perform 24 months after the first rate cut. And we've seen the first rate cut in September. Last week, we've seen another one, 25 basis points. And actually, the 24 months after the first rate cut are kind of the sweet spot. Up 31%, up 39%, up 26%. So we're seeing increasingly more tailwind coming from the rate side, and especially in a very capital-intensive industry like mining. So the same study, 24 months after the first rate cut, mining stocks, Gold Bucks Index, up 267%, 26%, although obviously 2008, 2009, a brutal bear market. And then in 2020, 21, up 29%. So we should see from the rate side, we should see some support for gold and the mining space. Also for silver, actually. Now, the big question is gold already expensive? And it's hard to value gold. There's no cash flows. There's no DCF that you can run. But what we did for this one here is we compared secular tops with other monetary aggregates and other prices. So at the secular top in 1980, the monetary base was 157 billion, M3 money supply 1.5 trillion, US federal debt in billion 863. An average house costs $64,000. And if we compare it to the last secular high in 2011, well, gold is up 128% during that time frame. But if we compare it to monetary aggregates, they're up 15 times, 5 times. US federal debt up 1,600%. US median house price and the S&P 958%. And if we compare that to the current all-time high, I would say that actually, based on this comparison on a relative basis, I would say we're still not extremely overvalued compared to that. So we're living in a relative world and don't focus too much on nominal prices. And what is interesting is when we saw those secular highs in gold, actually the dollar index, the Dixie, was trading significantly lower, 86 in 1980, 75 in 2011, and currently we're trading at 104. So from my point of view, a weak US dollar might be a big driver for the price of gold going forward. Now, how do we value gold actually? We've got a monetary model that we explained in 2020, and there is only two parameters that we use, and you can read it up in our 2020 report. It's actually the M2 money supply and the so-called implicit gold coverage ratio. Now, we came out in the 2020 report and we said at the end of this decade, our forecast is $4,800. Everybody said that's pretty crazy. Well, actually, to reach $4,800, that's a CAGR, a compound annual growth rate from now on until 2030 of 9.4% per annum. Doesn't sound outrageous to me. And actually, our model works pretty well, although I've worked in a bank for quite a while, so I'm always a little bit critical when it comes to models, especially the very complex models. So we said last year's in Gold We Trust report, 2,660 is the target for the end of 2024. So we could be roundabout in the right environment. So we are right on track to reach that $4,800 at the end of this decade. Now I'm already coming to my conclusion, but before I would just like to say a big thank you to the companies that support us, because it wouldn't be possible to publish every year 450 pages of this report in German, in English, in Mandarin, and also in Spanish. We will publish the Mandarin edition. In 2 weeks, we publish monthly chart books. So it wouldn't be possible to employ 20 people that are working basically day and night on this report without the support of our partners. You all know them pretty well, so thank you very much. And I'm also already coming to my conclusion. Now, ladies and gentlemen, gold has decoupled from its inverse correlation with US real yields. Very important. Also, ETF flows are not as important as they used to be. Of course, that can change. But in this new gold playbook, we should look at different indicators. Central banks and emerging markets investors are now in the driver's seat, while Western financial investors are still mostly on the sidelines. The traditional 60-40 portfolio is obsolete. Inflation is not that. If you have a look at how the market was pricing out inflation risks over the last couple of months, now it has stabilized and is going up slightly. But people are completely ruling out that there could be another wave of inflation. From my point of view, inflation is definitely not that. The US dollar might soon enter a secular bear market. This is actually what Donald Trump wants, what he was also very vocal about. But the big question is, can he achieve it? And how can he achieve it? But that would be my take. I think over the next 4 years, we'll see a structurally weaker US dollar. I think that active management is crucial when it comes to investing in mining stocks. And I think we're seeing a stealth bull market in gold. So a short-term correction is happening now. I think we can trade down to 2,550, 2,500 easily. 2,480 is another support zone. But what should you be doing in a bull market? You should buy the dips. So our long-term target, we stick to that. I know that in 2020, when we came out with that 4,800, people said, what are those guys smoking, drinking? What are they actually doing? How do they run their models? They're still saying that. Many people say, okay, 4,800, it could be possible. And again, it's 9.4% CAGR. And I still think that there still be some mining companies out there that will still manage to lose money when gold is trading at $4,800. So this is actually the job that we're having, to separate the wheat from the chaff and to really find out which companies and which management teams are doing a good job and which ones not. So thank you very much for your attention. Enjoy your dessert